There is a lot to this entire retirement piece than picking the right stock or the right mutual fund or, the right CD, for example. And that's why you have a nice review process and whatnot.
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future, helping you get retirement ready. That's the theme of the program today. He is Chris McIntire, president and founder of McIntire Retirement Services. And Chris, I think a whole lot of people probably could say, "Oh, I'm so ready to retire. Like I'm just sick of going to work. I'm ready to retire." But are they really retirement ready?
Yeah, that's a good analogy there, buddy. I think on Monday morning, that poll favors that answer very well. And some people are very well ready to retire and they don't even know it. Some people will want to retire and they're not sure if they're ready. So it is something that we address. And just here in the past week, we have a nice client, a single female client who is getting ready to retire, and we had to go through the process of pensions and social securities and all that. And, she had some good news, got a notification that the pension is even going to be greater than what was anticipated. So kind of lit up our week there.
Yeah, absolutely. I'm sure is going to help her into and throughout retirement. That pension income, that was a big part of the success of retirement for many Americans of like the previous generation. But now less than 15% of workers have pensions. And retirement, Chris, has really undergone a lot of change and evolution in, say, the last 150 years. 1875, American Express offered its first employer provided retirement plan, America's first employer retirement sponsored retirement plan. So thank you, American Express, for that. But 150 years later, Chris, we still have more doubt and worry and uncertainty about our outlook for retirement.
Yeah, without question, more so now than ever before because it's so much more on the individual's responsibility to save enough money or invest enough money is probably a better analogy for their long-term, retirement. Because, let's say you retire, we'll just use 65 because that's when you get onto Medicare, and that's, pretty popular age for many people that don't have pensions is health insurance is expensive out in the marketplace. So they hit 65, pull the trigger, want to retire, and it's not like they sit on the porch. I mean, they want to go to Florida, do they do a second home, buy a motor home, do things while they're younger and healthier? And then, as time goes on, like my parents, for example, are, 91 or 92 and 87. So, they don't do much. They stay, they're homebound for the most part. My dad goes over to the golf course, has coffee with his buddies, but they certainly don't spend like they did when they initially retired. And, so it's almost like you need to, you're front end loading your retirement, so that you can live early. So there's almost two phases to it. That first 5 or 10 years where you're doing a little bit of heavier spending and then tailoring off later on in life. And hopefully you don't go into a nursing home and have, a lot of catastrophic healthcare costs.
Well, and if you're making good decisions through especially the last few years of your working career and especially that first decade of retirement, then the remaining years remain fairly stable and confident. If you're maybe off a degree or two, or making poor decisions, or don't have a plan and are sort of just winging it in those first several years of retirement, Chris, it's not like you feel it in those first several years. You feel it in the second and third decade of retirement when the confidence wanes and slips because of the decisions or the lack of decisions, the lack of planning you may have been doing in those first few years. So again, we're going to talk about being retire ready on today's program. It's a 31-page guide, by the way. And if you would like this guide that we will be referencing throughout the program today and probably in the coming weeks as well, Chris McIntire has a copy. He can send it to you, email, digitally. I would be happy to provide it. All kinds of information on why we're not retire ready and how to become more ready for retirement. That is going to be the theme of the program. And again, it is the 31-page guide. If you would like a copy, give McIntire Retirement Services a call, 866-695-2620, 866-695-2620, the number to call, or you can go to McIntireRetirementServices.com, McIntireRetirementServices.com. And as always, Chris does offer the opportunity to help you structure your game plan for retirement, a written plan to help you be ready for retirement and retirement ready, financially prepared to face all of the years and decades into and throughout retirement. Chris, there are three separate phases of our financial life. We move and change and evolve through them, but it is important to recognize the distinct financial differences and needs of each specific phase of our financial life.
Yeah, without question. And, right now with all the talks of tariffs and, inflationary pressures and whatnot, that higher risk bucket, the stock side of things, as we put as long-term dollars, it certainly can cause some emotion with clients. We've had a few calls and emails here of, hey, what do you think is going to happen with all the tariffs and all that? Should we move our money out of the market? Thankfully, when we design portfolios the correct way, they're built around the client's supposed long-term risk tolerance, it's one thing, people's risk tolerance when the market's going up 25% is a heck of a lot different than when it's going down 25%. You can't get equity returns in money market risk. Those things don't happen. But that's why you balance a portfolio, to help you get through those different phases of retirement. You might have an income bucket, and then you might have a moderate risk bucket and then a higher risk bucket. It's pretty good analogy here. I got a number of clients. We do that bucket phase and just really help simplify things. And, you can visualize that, say, okay, and again, we'll just use a big number. I got $1 million. I want a third in my income bucket, a third in my moderate bucket, and then a third in my high risk bucket, just as an analogy. And sometimes a third in the high risk bucket is probably a little much for many people listening to the show today. They would, prefer to go a little bit lower and slower and a little bit more on the consistency versus trying to get an outsized rate of return. They just, would prefer not to take that type of risk. And that's fine. We do that all day, every day.
And Chris, shooting for those higher returns, like that is part of the investing timeline and evolution. Generally, we're doing that in our 20s and 30s and maybe even into our 40s, early 50s. But sometime there we switch and we move from what is called the accumulation phase to the preservation phase, and aptly named, right? At that point in time, it's not really about shooting for those higher returns and taking wild risk where we could lose a significant portion of our life savings, like years of our work and investment, just because of the swift change in the market environment, right? We don't want to risk that, and that's why preserve is in the name. It's the preservation phase in maybe those 5 to 10 years before and 5 to 10 years after retirement. Why is that so important?
Well, it's always makes sense to have a portion of your nest egg in a safe account, because you look in like the year of 2022, they raised interest rates 11 times. Okay, that was one of the worst performing years for bonds, which are initially, typically designed to buffer a portfolio in volatility. Okay, well, rising interest rates is bad for bonds, especially when they do it 11 times. And then on the stock side of things, those stocks also took a pretty good hit as well. So, that's why if you have an account that's very safe, and you can say, well, look, hey, right now a money market or a basic CD, a fixed annuity, an index annuity, can give you principal protection with some upside potential there. And, that way when your nest egg, the other part of your portfolio is falling significantly, you can come over here and rely on some safe money. And, right now, one of our biggest holdings is still in the money market side of things. I think there's $6 to $7 trillion in the United States in money market accounts. So, if we get a sell-off in the stock market, some of that money is going to come back in and will eventually fuel further growth, and nobody knows exactly the date that's going to happen.
Do you find, Chris, that it's difficult to make that mental transition, that you have to talk to investors about whether or not they need to tone down the risk or raise up the risk? Maybe there's too much in money markets and when we actually need a little bit more growth potential for that. Or, you are not in the same place that you were 20 years ago, yet your portfolio looks like you are. Maybe it's time to take some gains and some risk off. Like, is that a regular conversation that advisors are having or should be having or have to have with their investor clients?
Yeah, yeah, without a doubt, buddy. Because as you go through, different phases of retirement, the initial phase where you may still have more money in stocks for that long-term growth and that, to help keep or outpace inflation, ideally, is what you're trying to do there. We had, conversations here just around the president's speech here, with talks of tariffs, some, pretty significant volatility in the markets, and some of them you have to talk and into not getting out of the market because you don't know when the market's going to take off again. And, many of them in all reality, don't have any idea how much risk they're truly taking. 6 months goes by after we had a discussion and, it's not something that's on their front brain. And all of a sudden they say, hey, let me touch base with Chris and, let's see, where are we specifically here? Do we need to make any changes? And, we're not day traders, or anything like that. Warren Buffett, is sitting on a big pile of cash right now. He's waiting for his next opportunity. And, but, not all of us are Warren Buffett, for example.
Oh, how about moving into that next phase, right? There's three: the accumulation, the preservation, and then the distribution phase. Chris, is it tough to actually convince investors who have been working and budgeting and saving their whole life to then start making withdrawals and spend some of their retirement assets?
Yeah, it really is, because they've just been, especially if you've been a diehard saver and you've lived below your means,
It's like
you,
hardwired into us, right?
yeah, yeah, without question. And, um, I go back and I look at all the clients that we have. So obviously we deal with lots of different personality types and everything. So, psychology does play into this. And, if I'm working with somebody right now who's getting ready to retire and said, look, am I going to have enough money? How do I take money out of these accounts? All I've ever done is put money into them, the accumulation phase. And then now they're in the distribution and the preservation phase. They're like, look, how do we invest this where all I'm taking off is the skimming off of the dividends and the interest? Are we going to create enough? And I'm working on that with somebody here, over the weekend here. Client says, hey, draw me up an income plan that got money in different places with different folks, and we kind of quarterback it for them and to say, okay, based off of what you're looking at, based off of your nest egg, here's what you should be looking at. And I can't control what somebody else is doing in a different lane of the pool, for example, but we like dividends. We have some high yielding notes and whatnot that we use. So, creating portfolios in that 4 to 6, 6.5, 7% distribution range is not out of the realm of possibility based upon your risk tolerance.
And then, Chris, not only does our situation change going from the accumulation to preservation to distribution, but I've heard, like, retirement is the second half of the game. You have a lead at halftime, you go into the locker room, you come out for the second half, and you've got to finish the game, right? But when I hear that analogy, I always think to myself, yes, but the rules of the game in the second half are the same as the rules in the first half. Whereas the rules during our working career, it's almost like it's a completely different game, different set of rules when we hit that distribution phase.
Yeah, without question. The analogy, you and I are sports guys here, and your hockey team beat my hockey team here recently. So
Felt
we
bad about
started
that.
we started the show with that, folks. So it's often been said that offense wins you a game, but defense wins you a championship. And that would be a good analogy in retirement that, look, you're playing offense to get you through retirement. Now we're at, call it halftime, if you will. Okay. And then as you're playing the second half to try to bring it home and win the Super Bowl, or Ohio State win the national championship, for example, you need defense to help protect that lead, so to speak. So a great analogy right there.
Well, again, if you would like help constructing your game plan for retirement with an experienced, qualified professional who understands all of the rules of the retirement phase of life, because again, they do change. It's the second half of the game. Your needs change, but the rules of the game change as well. And what's going to help you win? That's different also. But you need somebody on your side, on your team, a coach that will help you understand those rules and then implement a winning game plan. That is Chris McIntire. That's why he helps savers and investors design the game plan for retirement, the written plan for your lasting retirement confidence and stability. If you would like to take advantage of the offer to get that written plan put together, no cost, no obligation, call McIntire Retirement Services at 866-695-2620. 866-695-2620. You can also call for the guide that we are referencing on today's program, Retire Ready. It is a 31-page guide packed full of information on what we are lacking for lasting retirement confidence and then how specifically to address those things. And page 7 of the guide, Chris, talks about retirement planning today entails more than just investment management. And I know that you and your team do investment management. You help your clients with those investment accounts, those brokerage accounts, those joint accounts, those qualified accounts, IRAs and 401ks and Roths, and bringing them all together, managing the market component or what investments, what funds should be in there. That is important, but that is not true retirement planning, or at least not all that it entails. Retirement planning is going to encompass income planning, healthcare planning, legacy planning, and the investment management. So a whole lot more, again, goes into this than during our working career.
Yeah, without a doubt. I mean, we try to keep things on a simple guidelines for the clients and whatnot. But, there's a lot of complexity here because, you get into tax implications, Social Security filing strategies, long-term care issues. There is a lot to this entire retirement piece than picking the right stock or the right mutual fund or, the right CD, for example. And, and that's why you have a nice review process and whatnot. Peter, we recently kind of changed our headquarters of our office into Fremont, which is the headquarters of our operation, so that we can, kind of revisit our service model as business grows. We have to make some of our adjustments. So we call it not the Department of Government Efficiency, but the Department of Office Efficiency is rolling through McIntire Retirement Services in 2025
Beautiful,
also.
beautiful new office location, by the way, Chris, and congratulations on that. It is a great location and a beautiful setup.
Yeah, my pleasure. And if anybody needs help putting desks together that you buy from some of these online places, I am the absolute master right now.
Yeah, recent experience helps there.
Yes.
Well, it is a great location. If it's been a while since you visited, ladies and gentlemen, if you are a client, if you've come in and spoken with Chris or the team previously, or you would like to get that plan put together, come check out the new McIntire Retirement Services headquarters there. Their new and improved and expanded Fremont office is absolutely beautiful location, and they'd love to show it off. They'd love for you to see it. Give a call, 866-695-2620, 866-695-2620. Back to our guide on Retire Ready, Chris. 3 common sources of income in retirement. Number 1, pensions. Number 2, Social Security. Number 3, personal savings. And we talked about already, we started the show saying how Americans now have a lack of those pensions. That really leads to some instability. It means we have to do far, far more personal savings.
Yeah, without a doubt, buddy. And I'll give you an example here. We're recently working with some new folks here, and retired teacher with a very solid pension. A husband has nice Social Security benefit. So for the two of them, when we inputted all this data into our software program called Invest Cloud, it calculates, look, here's our monthly expenses, here's our monthly income and all the investments we have. and it kind of computes into a nice software program that 97% of their retirement income was coming from the pension and the Social Security benefit. So that means they only need 3% of
Wow.
their income to come from their investment portfolio. And man, that's pretty, they're in very good conditions. Now,
Yeah.
and so I did the math on that pension. I said, okay, at 4%, the money that your pension pays out is equal to about $1.9 million. So
Wow.
that's what they would have had to save on their own to draw 4% off of it to equal what the pension does. And, very nice pension. And so without that, I mean, just tells you how much more money you have to save. If you want a $100,000 income in your retirement and 40,000 of it comes from Social Security between a husband and a wife, you got a $60,000 shortfall. What do you need? $1.5 million at 4% to generate that. Now we can do it a little differently and up that yield, but I mean, that just shows you the challenges on what you really need to be saving to live, an upper middle class lifestyle. I think most people would think $100,000 in retirement's a really solid income.
I had a friend, Chris, who recently he had one of those trikes. It's like a motorcycle, but it's three wheels, right? And he recently sold that. And I asked him, okay, well, are you now going to buy a motorcycle? He said, heck no, those things are dangerous. And like in thinking about this analogy with the three sources of retirement income and the pensions now being absent, it sort of reminded me of that. And some people haven't even done, the personal savings that we really need to support ourselves, not to mention supplement where that pension is now absent. And then Social Security is saying that it's in danger. It's like now we're riding a unicycle and somebody's about to kick the wheel out from under us.
Yeah, exactly. And I'm going to say a one wheel because I ride a one wheel personally, and my buddy should be. Hopefully, he listens to the show here today because he's on the list that gets our radio show. A one wheel is like a skateboard, battery powered skateboard with one big wheel in the middle of it. So that and that's a pretty dangerous operation. But to ride a bike, you got two wheels. And again, kids start off on tricycles before we put them on bicycles so that they don't fall. And the same thing with your buddy who, sold his motor trike, whatever you want to call it, three wheels. So he did that so it was safer, right?
Yeah. That's why he had it in the first place. But yeah, it seems like the retirement situation is getting more tedious, more precarious, and more difficult. And I think we're seeing that because Chris, for the last 15, 20 years, I know poll after poll has said we have less confidence in our retirement outlook than the generation before us. And those stats seem to be getting worse and worse, even though for the majority of Americans who are saving and investing, we've amassed more personal net worth, more investment, more personal assets than generations prior, but we have less confidence in retirement. Part of that, right, is understanding the potential risks to our retirement. Chris, the Retire Ready Guide outlines 6 of them. Number one on the list, risk number one, you may outlive your money. And I know we're living longer, so the risk of that just keeps going up and up as well.
Yeah, without a doubt, buddy. And if I talk about this with the staff and everything is, as we look at the risks that we're taking, are we, how do we calculate and mitigate those types of risk? And, we live in a 24-hour news cycle, and now everything has been about inflation, which is created at the federal government level by their overspending. And I'm sorry if that offends anybody politically, but both parties since COVID have spent an incredible amount of money, makes everything expensive. And now that we're trying to wean ourselves off of that, right? We have to go back to an economy that's driven by the consumer, not the federal government by and large. And that's got some volatility, and egg prices are the big thing going on right now and whatnot. And
Yeah, that's going to make or break retirement, right?
yeah, with the bird flu and all that. And, but it just, inflation hadn't been a problem, and now it is. And when you're on those fixed incomes and you're like, well, look,
Yep.
man, it's getting more and more expensive. My wife and I, we go out to eat lunch. It's like, how is lunch $60,
Oh, you're getting off
at a
cheap.
fairly, yeah, at a decent place to eat. My goodness.
Yeah. Well, you said not to offend. That should offend everyone, not because you said it, right? But because it's happening. It continues to happen. It has happened for a generation more than. Last time we had a balanced budget was 2001, right? That is of age at this point in time.
Yep.
It is so long ago, we can hardly remember what a balanced budget is. And that Washington keeps overspending, and then we keep living longer and longer, not necessarily healthier and healthier, so that the lifespan that we have continues to get more and more expensive. And that's dovetailing into risk number two, Chris, which is the U.S. national debt. At some point in time, we've got to kind of come to terms and reconcile. I don't know when, but we've got a change in leadership every 2 years in this country. At some point in time, the spending, where we're now $37 trillion in debt, there's only kind of two ways out of that predicament, right?
Yeah, yeah. You either cut spending or raise taxes, or a combination of the two. And raising taxes is difficult. And Peter and I are self-employed. I'm going to jump up on here on a soapbox. We invest in companies. All of us listening to the show, we invest in companies, and when those companies get bloated and unprofitable, they have to revisit and trim the fat, if you will, and sometimes that involves layoffs and whatnot. But that's the business environment changes, and all the complaints and all that about what they're doing in the federal government. Well, they're taking that money out of my pocket and putting it into theirs. And if we don't need them, I'm sorry. Why am I paying for the waste? So forgive me, I get passionate on that because we mail in, about 45% of our efforts, and we don't want to pay for waste.
Well, I think due to time, Chris, we're probably not going to be able to get to all 6 of the risks, but we are actually only 11 pages through this 31-page guide of Retire Ready, ladies and gentlemen. If you would like this guide, give Chris McIntire and McIntire Retirement Services a call. But again, the real value of the program, we discuss these important topics. Chris helps you to specifically address them in your planning for your situation by designing your game plan for retirement. So again, if you'd like the guide on your own, Chris is going to email that out to you. But the real value, take Chris up on the time, on the opportunity for the complimentary review, the retirement planning tactical strategy session at no cost, no obligation, and get your game plan for retirement designed. 866-695-2620, 866-695-2620, the number to reach McIntire Retirement Services. We'll come back. We'll talk more about this guide, I'm certain, in the coming weeks. The following risks: Social Security, Medicare and unplanned health expenses, inflation, and then a combination of everything else. We'll address all of those into the coming weeks and more here on Your Game Plan for Retirement with Chris McIntire. Chris, an excellent guide. I love this resource. I love that you're making it available, but more important, I think people need to apply this information to their situation and get their game plan for retirement. And we so appreciate you doing that for listeners to the program.
Hey, my pleasure, everybody. And Peter got me all fired up, so I got to go take a walk now. Thank you.
All right, blow off some steam, Chris, and then come back and put those game plans for retirement together. Get folks ready for retirement. Again, ladies and gentlemen, if you'd like to get your game plan for retirement, give Chris a call, 866-695-2620, 866-695-2620. Again, appreciate the time, Chris.
Yep, thank you. God bless America.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.